I spent last week doing a lot of research relative to Supermicro Computer and their new financing. In fact, I did 5 videos relative to it. And I was asked recently, why didn't you remove them from your watch list in the portfolio that you track? And my answer was because they are a part of the ecosystem which I follow, and that is the AI ecosystem, which takes in semiconductors and software and hardware and data centers and such. And so that's why I keep them on my radar. Another stock that I kept on my radar is Applied Digital. I don't own any of it, but I think it's important to understand what they're doing so I understand the whole ecosystem. And they just came out with some major changes in their financing, similar to what Supermicro did. And I thought, as an analyst of stocks and wanting to understand how companies finance themselves and what if they're doing is for the benefit of me and the investors, or is it for the benefit of the founders and their executive staff. So I did an evaluation of Applied Digital's financial health. And what I came up with was they had increased their debt from $79.5 million in 2024 to $468.2 million in 2025 as of the last report, which struck me as a six-fold increase in their debt. And debt is not a problem, as I've learned from Goldman Sachs. Debt is an indication that a company sees or foresees some growth potential in the future. And it may be, in fact, an indication of a good investment opportunity. So I went further and I found, by going through their finances, they also added some preferred stock, which wasn't there in 2024. They added some $43 million of convertible preferred stock with a dividend of 12.75%. That's a pretty healthy dividend. That's in some cases just a good return. So again, I needed to take a look at that and see what that meant. And basically, what I came up with is it creates some dilution of their shares because their shares went from 139 million outstanding to 216 million shares, which is an increase of roughly 56%. I don't know that you and I, as an investor, would readily recognize that. And so that's why what I do is go and get the lending documents and read them and try to understand them, and then go to their books and see how does this new money they just acquired show up in their books, and how are they carrying it on their books, and how is that going to affect them in the future. And then what I attempt to do is to read in-depth articles to find out, why are they doing this? Well, what I found out is they're raising capital. What involves two recent agreements, one from Marquet Financial. They got a $900 million initial investment with the commitment of another $5 billion. And then they also went out and got an additional $375 million from SMCB to provide capital for acceleration of their development of their high performance computing system. This tells me that they are making some very strong strides to move forward so that they can be in a position to take advantage of the need for data center power and compute power from the hyperscalers. In fact, the agreement with Marquet and the additional $5 billion is contingent upon them entering into a large contract with one of the potential hyperscalers that might be available to them. In fact, the agreement with Marquet says this 5 billion will become available to them if, in fact, in a specified period of time, they enter into a specific amount of business with either Amazon, Google, Microsoft, or any of the other hyperscalers. So it's very specific. And the other thing I came to realize, these are substantial and very high standing banking companies or lending companies. It's Marquet and SMBC. So that tells me that there's someone other than them, and all of their prior financing had been done with the banking in North Dakota. So they're stepping up and they're showing that, in fact, the hyperscalers have an interest, but they need money to meet the demand. And so that becomes a positive, even though, as I say, they're diluting their shares and creating a questionable financial situation. My basic analysis says, on the positive side, if in fact they are able to bring on a large hyperscaler, what's going to result is rapid growth in the revenues, which I recognize that some of the energy that they use up there in North Dakota is renewable energy, which will turn into large margins, because the biggest expense after you've got the data center built and the servers installed, the biggest expense is electricity. So they are putting themselves in a position that they could take on some very rapid growth in a very short period of time at some very high margins. The negative scenario is if they're not able to secure the leases from the hyperscalers, their debt burden is going to eat them alive. Okay, that's just the long and short of it. So the key metrics we need to watch is any hyperscaler lease announcements. And then what they would probably do is then go out and refine that debt to take any premium away from it because of the better position that the hyperscalers have put them into. So then what I wanted to do is come up with a scenario of what exactly would happen in the various conditions as they move forward. And so what I did was I created a chart that said, okay, under a conservative, a moderate, and an aggressive strategy, with varying their margins from 5%, 10% to 15%, and projected revenue plateaus, what will that translate into as far as net income and then corresponding earnings per share based on the share analysis that I did? And it covers a wide range. Under a conservative analysis, they could increase their revenues currently at about 211 million up to 400 million. And this is, again, conservative, and that would still leave them in a negative earnings per share. But if you get their margins up to that, from their margins right now are 2%. If we could get their margins up to 15%, which would be high, that same $400 million in revenues would generate more like 8 cents rather than a negative 11 cents. So you can see the contingency of getting contracts with hyperscalers as a result of this heavy financing that they've been able to secure from some very substantial financial outlets could open the door for them and make them a major, major good investment. Going all the way to, if they go aggressive, and they can get those margins up to 15% from the current 2%, they're going to generate as much as 84 cents per share within the next 3 years. So that's my analysis of it. what I and I know it's complicated and it's detailed and it's 5 pages long. What I'd like to do is I'm going to do an email. I'm going to put this in this format, and it goes into all aggressives, explaining what the moderate, the aggressive, and what everything is means, and I'm going to send it to all my gold members. And I'm going to start doing more and more of this because I do this kind of research, and it's how I make investment decisions. But for everybody on the gold level, and the gold level costs $19.95 a month, I'm going to do something like this at least once a month on individual stocks. I've did something like this as well with Supermicro. I'll be sending that document out as well. And what I think it will do is put you in a position where you can make better investment decisions. That's the long and short goal of this whole thing. If you know what you own, and if you can add to that understanding the finances and understanding the books, now all this fluff information doesn't really have any consequence for you, because you understand the goal of these companies is to make money, and they report their strides or their progress at least every 4 times a year, and they have to put it out in their financial statements, and those financial statements are available to us. And if we know how to interpret them and then analyze them, we can create a 5-page document that tells us what's going on with Applied Digital. We can find the metrics we need to watch to determine when is the time to buy in, and what is the signal to buy, and what is the signal to sell, and what is the signal to hold. It's a lot of work. I enjoy doing it, quite honestly, and I will continue to do it for my tribe members. Again, this platform is $19.95 a month. I would guess if you had to hire me to do this for you, you're probably, and I did it for you individually, I'd probably charge you, I don't know, maybe $500,000 a year. But I'm willing, because I don't need the $500,000 a year, and I don't think it's fair. I'm willing to make it available to you for $19.95, and I'll just guarantee you it's just going to get better. So take a look at it and see if, and to you that already are in the gold platform, you'll be receiving this in your email within the next week.